Welcome back. Let's take a look at Knoxville Divergence. This is the indicator that I built in 2013 that's been the root of almost every massively successful trade I've ever taken. And you could use this on any time frame chart you like. First, let's look at how it's built, and then I want to show you some examples. Knoxville Divergence is a red line that will show up above your candles when it's bearish and below your candles when it's bullish. That line will only show up above candles if price has been rising, but the momentum indicator set to 21 has been falling. At the same time, the relative strength index set to 21 is overbought. So we have price rising, but the momentum falling, and the price is overbought. Think of throwing a ball or anything up into the air. If you take a snapshot in time of the ball up in the air up here, the ball is traveling slower and slower as it goes higher and higher. And that's an indication that momentum is dropping and the ball is eventually going to come back around and fall back down. That's exactly what Knoxville Divergence is warning us about. Now you can get bearish Knoxville Divergence like we see right here, but you can also get bullish Knoxville Divergence. And if we go back in time far enough, we can probably find an example of bullish Knoxville Divergence somewhere here on the charts. It might take us a moment, but it's definitely worth waiting and trying to find that example of bullish Knoxville Divergence. Let's see if it takes us 3 or 4 years. And there we go. We finally got an example of bullish Knoxville Divergence. Now, if I double click on these lines, what you'll see here is I want to look at the settings for the Knoxville Divergence. Okay, let's just go right up here. There we go. All right, here are the settings that I like for Knoxville Divergence. I like to make those red lines as thick as possible. And under inputs, what I like to do is set the bars back to 30. What that refers to, when you set the bars back to 30, that refers to how many bars maximum can be included in the Knoxville Divergence setup. So for example, that means that the maximum length of this line is 30. The shorter you make that line, the fewer examples of Knoxville Divergence are going to appear. The longer you make that line, up to 100 or 150 candles, the more divergences you are going to discover on the charts and the lower quality they become. I think a sweet spot is 30 candles back. Now, what are you going to do with a Knoxville Divergence signal once you see it? Well, when I come back, I'm going to show you a way to trade this with shorter term charts and intraday pivot points.